Welcome back, everyone, to episode 2 of our dividend investing journey. If you're new here, we are building a passive income portfolio completely from scratch. We're depositing $100 a month and buying pieces of great companies and letting our money work for us. Today, we're going to talk about the most important mindset an investor can have: keep an even keel. Investing is a roller coaster. There are red days where the stock value drops, and there are green days where they go up. But if you want to be successful, your emotions have to stay completely flat. Let's look at our account. Our total portfolio value currently sits at $200.29. Between our first episode and today, we've officially invested $200 of our own hard earned cash into the market. That means that we are up a grand total of 29 cents. Now, 29 cents might not sound like retirement money, but getting here was actually a bit of a wild ride over the last few weeks. We made a mistake, we bought new companies, and we hit a massive milestone that single handedly saved our portfolio from being in the red. Now, before we dive into the exact trades, let's talk about that even keel mindset. When you're faced with a stressful situation or sudden change of plans in your everyday life, are you the type of person who stays completely calm, or do you tend to panic a little bit at first? Let me know in the comments. Recognize how we handle stress is the first step to becoming a great investor. All right, let's look at the exact timeline of our $100 March deposits. On March 17th, we deposited our first $25 of the month. The goal was to buy our second stock, Home Depot, but we made a mistake. When that $25 hit the account, the app had an auto invest button toggled on. So before I could stop it, the app automatically bought $25 more of our first stock, Waste Management, at a share price of $237.46. It wasn't the plan, but keeping an even keel means we don't panic. Waste Management is a great company, so we just turned off the auto invest button and moved on. A week later, on March 24th, we deposited another $25. This time, with the settings fixed, we successfully bought our slice of Home Depot at a share price of $323.24. Then, on March 27th, the magic happened. We hit our first major milestone as investors. Waste Management paid us our very first dividend. They deposited exactly 41 cents of pure cash directly into our account just for owning their stock. And here is why this is so incredibly important. Remember how I said our total profit is 29 cents? If you do the math, this means that the actual share prices of our stocks have gone down 12 cents overall. But because Waste Management paid us the 41 cents in cash, our account is safely in the green. To celebrate, we rounded out March goal by depositing our last $50, and we bought into an absolute classic dividend company, Procter & Gamble, at a share price of $143.26. We now have 3 incredibly strong everyday companies in our portfolio. As we watch the total value bounce around, we have a secret weapon to protect our sanity. It is a strategy called dollar cost averaging. Because we commit to depositing and investing our money every single month, we're going to buy shares when they are expensive, and we're going to buy shares when they are cheap. Over the course of years, those high prices and low prices blend together into a nice, smooth average. Dollar cost averaging removes all emotion. You don't have to stay up late worrying about if tomorrow is the perfect day to buy. We just follow the schedule. The strategy is all about routine. What is one routine or habit you do on autopilot every single week without even thinking about it? Share your routines below. We want to make sure our investing feel exactly like that. Now, even though we buy every month no matter what, how do we know if Home Depot or Procter & Gamble is a good deal today? To figure this out, we use 3 simple tools. Think of these tools like the gauges on a car dashboard. Tool number 1 is the 120 EMA. That stands for exponential moving average. Think of this line as the average temperature of the stock over the last 120 days. If the current stock price is sitting below the line, it usually means the stock has cooled off and is essentially on sale. Tool number 2 is the RSI, or Relative Strength Index. This is our speedometer. It goes from 0 to 100. If the RSI is over 70, the stock is speeding. It's overbought and might be too expensive right now. If the RSI is under 30, it's going too slow. It's oversold, which means it could be a great time to buy. Tool number 3 is the MACD. This is our momentum compass. It tells us if the momentum is shifting. Are people selling or are people buying? When the MACD shifts from red to green or from negative to positive, it signals that buyers are stepping in. Now, before we make our buys next week, we will quickly check our 120 EMA, our RSI, and our MACD to make sure that we're getting the best possible value for our $100. And that is it for episode 2. We have 3 amazing companies. We survived an auto investing mistake. We learned to read stock chart. And more importantly, we got paid our very first 41-cent dividend. Before I let you go, of the 3 dashboard gauges we just learned, the 120 EMA, which is the temperature, the RSI, which is the speedometer, or the MACD, the momentum, which one made the most sense to you right off the bat? Let me know because we will be using them together next week. If you are enjoying this step-by-step look at building wealth, please hit that subscribe button and ring the bell. Hit the like button to help this video reach more beginners just like us. Thank you for watching. Keep an even keel and execute financial wealth. We'll see each other next week.